Hi, I'm Keith McCullough. Now, welcome back to another edition of Real Conversations, where it's my pleasure to have my friend, chief economist, chief strategist, chief everything at this point at Tressis, Mr. Daniel Lacalle, who's also, and incidentally, the author of a new book, his nice-looking picture right on the cover of that book, called The Central Bank Trap, Escape from the Central Bank Trap, which I appreciated quite a bit, Daniel, and thanks for taking the time to write it, not only because you were rightly critical of central banks, but you also, unlike many, provided some solutions. So first, I want to welcome you back, but also give you an opportunity to just maybe just tell people why you felt compelled to write this book. You've written some very good books on different topics, energy, full circle now on central banking, but you've always had an opinion on this, and I wondered why now.
Thank you very much, Keith. Thanks for having me, and always a pleasure. Why now? Because I think that if we had this conversation maybe 5 years ago, 6 years ago, I think that there would be a certain level of division in terms of whether monetary policy was something that was working. There could be questions about whether central banks were doing the right things. But I think that right now it's become quite consensual that that monetary policy and extremely loose monetary policy is not working, at least the way that it was expected to work. And but we hear lots of things, of different magic solutions. No, and instead of centering on real solutions, what we are hearing is, it's not that the central banks are doing the wrong thing, is that money should be created by government. Mm-hmm. It's that we should print money like they did in the French Revolution, and that would certainly help inflation for sure. So what I wanted to do was to take the conversation from what was intended when all this QE nightmare started, and to provide some realistic solutions, and also a guidance for investors to navigate the environment in which this monetary policy becomes part of the liquidity.
And blow by blow, this is a great book, really getting to the point. And some of your summary points, they're so simple, but so accurate. This one of my favorite one-liners: central banks do not print growth. You've been saying this one for a long time, but now we finally have it in print. Nobody can take it away from you. Can you just explain simply what that means?
Yes, I think that the idea that central banks are going to improve economic conditions so much that growth is going to magically appear, that central banks are going to create the foundation for businesses, for companies, for families to decide to consume, to invest, is simply incorrect. And I think that one thing obviously is that central banks, what they can do, which is to provide liquidity and to maybe generate a level of let's say, backstop in the markets in an environment of panic. But what they cannot do is to make people decide to invest or force consumers to be more confident, because people, the first thing that they're not is amnesiac. The second thing that they're not is stupid. So everybody perceives reality and sees that interest rates are an anomaly. Interest rates so low are an anomaly, and therefore they, instead of taking more risk, they take less risk. And they also see that extreme liquidity is not changing the perception of overcapacity, the perception of business opportunities, and therefore companies, instead of investing, decide to buy back shares and use that liquidity to increase dividends. It makes all sense.
Mm-hmm. I mean, so you debunk that. Basically, look, you can print money, but you can't print growth. But then one of my, I guess my second favorite one-liner from Daniel Lacalle is cheap money becomes very expensive in the long run. So what do you mean by that?
Well, basically, all this massive liquidity, what happens is that all that money is going somewhere. and we don't pay attention to it because it is not creating CPI, core inflation. It is not making prices rise. However, it is creating very big perverse incentives. Those perverse incentives are very clear right now. We've seen in the latest Bank of International Settlements report how zombie companies have gone through the roof. We have seen also how excess capacity and debt are perpetuated. So instead of helping deleverage, what excess liquidity and low interest rates does is to obviously incentivize more debt and more risk taken. And obviously bond yields, extreme low bond yields, they are very negative in the sense that investors are taking more and more risk for less and less return. Therefore, we are creating an imbalance between the reality of risk and the price signals, and that evidently generates very large challenges and definitely very large imbalances in every economy.
Well, I mean, the biggest imbalance, of course, is debt. We get questions about it all the time. Keith, how can you be bullish on U.S. growth given all the debt? And frankly, there's no way to answer that because they're on two. You know, the debt problem is a much longer duration problem than a short-term economic cycle, if that is indeed a tailwind. So I wonder, on that front, like, how do you answer that question about debt? I mean, you have an entire chapter in the book that's literally titled "Debt is not an Asset." I just wanted to get your how you take that question from investors or more broadly. I'm sure you get it all the time.
Yes, I think that you've just nailed it. It's the difference of duration. So one thing that excess liquidity and massive debt does is that it shortens economic cycles. It makes them more abrupt. Mm-hmm. Therefore, growth and recession periods become more. You see more and more periods in which, in a longer term spiral of not really growing, what you do get is periods in which the economy suddenly has an abrupt increase in why? Because as we're seeing in the US, consumption rises very, very well, yes, and you see a little bit of increase in capital expenditure. But if you look at it from a longer term perspective, actually it's a question of duration. Exactly, all of this debt is creating an asset which is very quickly generating a very short-term effect, which is a little bit more consumption, a little bit more, a little bit more investment. Then it all falls back very quickly. So what we need to see is basically the debt is creating stagnation, but within stagnation you have periods of little blips.
No, I mean you almost have to communicate it like that, like so simple, by moving your hands along the sine curve of a line, because for whatever reason, the intelligentsia of economists and mainstream media can't quite understand how to talk about one duration and get it right, never mind them both at the same time. I guess that's the definition of sanity, trying to maintain these countervailing thoughts at the same time in your head and not just like throw up on yourself. But the reality is that, what do you think about that within the context of Europe's cycle? To me, it's almost crazy, but it shouldn't be, but it is, because it is. People are just coming to the realization, I suppose, that Europe is growing. I mean, Europe started growing, or at least stopped being in a recession in 2013. Why is it that so many people think that Europe is back? And what do you think about that cycle in terms of where we are at this point in time?
I think that what people are seeing is that the cycle of stagnation of the economy, in which you have, for example, very long-term trends that you cannot escape, like aging of the population, like overcapacity, like low return invested capital. All those things are things that you will definitely see generating further stagnation further down the line. Now, what we're seeing in the European Union is that growth is coming because it's coming from a very low base. You've gone from a depression to a recovery. And we are confusing recovery with growth. Recovery is not growth. Recovery is simply that you get accustomed to that overcapacity simply staying idle, that the banks with all of their challenges are starting to make a little bit more money. That doesn't mean that they're making positive net income margins or that they're generating high return on tangible assets. No, it means that they're just recovering. And that's what we're seeing. The European Union cannot be constantly in a recession period, and that's what we are seeing right now. We're seeing that return, that V-shaped return on a longer term trend line, which is stagnation.
You put up a note last week that definitively said that Eurozone growth seems to have peaked. Now, can you go through that?
Yes, if you look at the PMIs that came last week, you see that something that's quite interesting is happening. The economies continue to be in expansion. However, the pace of that expansion is much slower, and more importantly, it is equally debilitating, weakening in services and in industry. So what I think that we're seeing in the European Union is that because the recovery has been generated fundamentally from an increase in exports, much larger trade surplus than expected, and a recovery in consumption, but capital expenditure, a gross formation of capital, that is not increasing, even less so at the levels at which money supply is growing. What you end up seeing is that that period of expansion weakens very quickly. Mm-hmm. And we are seeing it, for example, right now with inflation expectations. Inflation expectations rose very, very quickly, probably too aggressively at the beginning of the year because of the base effect, because of oil prices. Yeah? And what ends up happening right now is that we're seeing inflation expectations being revised downwards dramatically, almost 50%. So I think that what we're seeing is that at the end of the day, as much as we want to place a lot of faith in monetary policy and a lot of faith in that recovery, France is still in stagnation, despite whoever wins the elections. Yeah? Italy is still in stagnation, so it's very complicated for the European Union. Even if Spain or Portugal come back from the lows, it's very difficult for the European Union to generate growth above 1.72%.
That's interesting. The amount of people that I speak to that are not Europeans, now this is interesting, I'm sure you'll get at least a bit of a chuckle, but the amount of people 3 months ago, Daniel, that would tell me that it's different this time in France, you just wait and see, and this is post the election. I just, for the life of me, can't figure out how that could be true. I mean, demographically and from a debt perspective, we can go across all the different metrics, but I don't think it's different this time in France economically, do you?
It's not different. There is nothing different. We've seen this before. Anybody that's been in the market for a period of time, you and I, we've seen it. We saw it with Sarkozy. When Sarkozy was elected president, we heard everywhere that big reforms, big changes, etc. If you think about it, somebody told me the other day in France, was telling me that if a president doesn't make drastic reforms in the first 100 days in France, he's not going to make it. He's not going to make it. You want to see what's the first big decision that the French Prime Minister Macron has taken? The first decision has been to nationalize a port because the Italians were going to buy it. Is that the reform that we're thinking about? And there's been no labor market reform. There's obviously been no public sector reform. The public sector, as you know, is one of the largest in the world. It's around 22% of the workforce. And it's a very directed economy. It's the model that, by the way, that Mr. Macron, nothing against him, learned in the public school of public servant, learned is the directed economy. So if the first decision of an allegedly free market-oriented prime minister is to nationalize a port because it's going to be taken over by the Italians, I think that we should be a little bit skeptical about saying it's going to be different this time.
Well, actually, and this was a great, and thanks for doing it, in the Hedgeye 21, which was an interview you did for us. You got asked which European country is the biggest cause for concern in your eyes. You did not say France, but you did mention the name of the country a couple times now already. Can you get into what's going on in Italy?
Yeah, well, the main problem of Italy is that it needs structural reforms that require a very strong government. Italy has had more than, I don't know, I think I've lost count, but more than 50 governments in the last 70 years. So I think that the main problem for Italy right now is that it cannot undertake the drastic reforms it needs to clean up the banking system, which has one of the largest percentages of non-performing loans, to improve the business conditions, to improve the export conditions for companies, to allow SMEs to grow. This cannot happen with a government that it will likely be, again, in a very weak minority, and in an economy that, again, suffers from those same challenges that we were mentioning before. We were talking about aging of the population, a big problem in Italy. Divergence between the north and the south. The south continues to be a very challenging part of the economy in Italy. A very good exporting sector, however, hindered by very aggressive regulation and very misguided bureaucratic excess. And another one is obviously the excess of debt and the fact that the financial system did not undertake a reform like, for example, Spain did, and clean up its act as quickly as possible, or at least present the real problem in order to improve credit growth to SMEs and families.
The base reality that both France and Italy, well, really Spain, Portugal, Italy, France, are going to get older faster in their core spending cohort of the economy. We've showed this however many times we can, Daniel. You know it. It's the biggest spending populations around the world, 35 to 54-year-olds effectively. We follow the growth rates of these populations. There is no place, including Japan, that is going to be as bad as Spain, Italy, and France for the next 5 to 10 years. And I wonder, if there even is a solution to that, if there's not a basic acknowledgement that if that is your core consumption component of the economy, that there's nothing that can stop that decline.
It's very difficult, and it's very difficult because that problem was sorted out, for example, in Spain in the early 2000s with a massive increase in immigration coming from Latin America that came attracted by the construction boom. But none of that is there anymore. And the type of immigration that is coming to the European Union is not the same type, is less easy to integrate, is much more challenging in terms of the cost to the welfare state, and the aging population creates that big problem in the public accounts that is the pension deficit. The pension deficits in the European Union are very, very high, and what governments are doing is to tax the productive and the parts of the economy that actually can spend and invest to maintain the pensions. So by doing that, you are having a double negative impact on the economy. On one side, debt is too high and the imbalances are too wide. And on the other side, you are taxing the ones that could actually lift the economy further, therefore growth doesn't happen. So it's it's one of the big challenges, this system, by the way, that Japan was not able to sort out either. So not an easy one to figure out.
But if you really think about it, a major central planning mistake in 2011, as you know, was Jean-Claude Trichet raising rates or tightening into a European economic slowdown. Do you think that that's the same risk now? We have more debt today than we had then. The demographic curve is worse today because we've had time and space to live through than it was then. Do you think that if they were to taper, tighten anything that would tighten monetary conditions in the Eurozone, do you think that that would have a negative market impact?
I don't think it would be the same. I start in the book by giving a little bit of credit to Mr. Trichet, because if really the problem of the European Union was to raise rates from 1 to 1.5%, then, my friend, we were in real trouble in the European Union. So, if that was the problem, is if businesses and countries were completely unable to survive with such a ridiculous increase in rates, then the European Union was in a much bigger problem than what people perceive. But let's go back to the situation with the European Central Bank. I think that the European Central Bank right now doesn't find itself in the same problem, because right now in the European economy you don't have such a massive level of debt at the corporate level, and you don't have families as indebted as you had them in that period.
A good point.
So the big problem right now is only at the government side. It's a big problem, but it's not the same as in that time.
Now, in terms of how you would try to find a way out, on page 153, you go through that, how to get away from these expansive policies. What do you think should be done?
Well, it has to be a combination of guidance and policy. The first thing is central banks need to be a lot more clear about guidance on the things that they do control. One of the big mistakes that central banks have made in the past years has been to talk constantly about things that are second derivatives of policy at best, like unemployment, like growth. Central banks don't bring growth, and obviously central banks don't create jobs. So what they do control, and what they do have understanding about, is credit growth, what type of credit growth is being created. What they do understand is excess liquidity, and what they do understand, obviously, is whether the prices of risky assets are becoming too aggressively priced or they're correct. So the first thing that they need to do is to be a bit more, quite a bit more detailed about that, and they're starting to be. At least we can give a little bit of credit to Mr. Draghi for being a little bit more detailed in that front. The second thing, not just guidance. The second thing needs to be that the European Central Bank, like any other central bank, cannot say we're going to tighten monetary policy in such and such period if this and that happens, and then not do it. Because that creates the perverse incentive in markets of behaving in what in the book I mentioned in buy the bad news. So because buy the bad news, because then the central bank will have to take expansionary measures. So I think that they need to be a lot stricter, and I think that that's why in implementing a Taylor rule that leaves very, very clear when the central bank is going to start normalizing monetary policy, and that it doesn't put it at the discretion of a committee's decision, but on hard data. That would certainly at least put a lid on the risk of creating massive bubbles and then a bigger problem that cannot be sorted out, lowering interest rates and increasing liquidity.
So a little bit more rules-based on the tilt, and that argument's obviously been made in the U.S. And then once you get to the guy who wants to be 100% rules-based, people are scared of him or her. So I wonder who's going to have any rules-based system. But do you have any hope that could happen sooner in the ECB or in Europe before it happens here in the U.S.?
I think it has to happen, because I think that by now, central banks, they might not agree with it in public, but people and experts within the central banks are starting to realize that monetary policy and extremely loose monetary policy, first, it's not creating inflation. Second, as the Bank of International Settlement, as so many analysts are showing, is creating zombie companies to rise, is making, is perpetuating imbalances, and is definitely making valuations in markets get excessive. So I think that in some form they need to go back there. I think because a central bank, going from having credibility to having no credibility whatsoever, and then having a big monetary crisis, is a very, very thin line. Therefore, in order to restore credibility, they need to be more factual. They need to be less about we think that maybe, that yes, but no, but the sort of Little Britain approach to communication. They need to be more factual. And they need to do it because if they lose credibility from the financial markets, from citizens, etc., in a period of such high liquidity, then they run the risk of creating a much bigger problem, which is a monetary crisis in the middle of a currency war. Imagine.
Yeah, I mean, this is, well, you called this your biggest fear in the Hedgeye 21 questions. This is probably the best answer I've heard, which is your biggest fear is the glorification of ignorance.
Absolutely, absolutely. We've come to the point in which you have almost on a daily basis, you see people that are praised for saying this time is different. Fundamentals don't matter. It's a new paradigm. So it's really scary. It is really scary. It's really scary when people tell you that governments should not worry and they should issue as much debt as they want because it's a fantastic asset and it doesn't create any risk or any consequence. So all these things are very, very dangerous. Very dangerous, and they're very dangerous because they're being glorified as a new way of thinking, as a different approach to understanding money and understanding economics. They're not. It's the same old lunacy that made Nero, the emperor, decide to put a little bit of steel in the silver coins and think that nothing was going to change and almost destroy the economy in the process.
Imagine Nero had Twitter, I tell you.
No, I don't even want to think about that.
No, but thank you very much. I mean, I'd be a lot more scared if we didn't have, people like you writing great books like this that make us think. I mean, these are the economic truths. This is the reality. Like you said, until we're talking at least within the area code of the truth, there's no real way to get away from what we've done to mess this up. So I genuinely appreciate all the time you've put into writing books. I know that that's not an easy thing to do, but being concise and teaching people something in a way that, in a very difficult space, which is economics, to absorb. I think that you've taught a lot of people, and I think you're going to teach a lot more by the time this is all said and done. So thanks for that.
Thank you very much.
All right. He's Daniel Lacalle. You can find him on Twitter. He is prolific on Twitter. He is the purveyor of all economic truths on Twitter. We go back and forth together, too. We have a lot of fun. But again, he's the chief economist and CIO at Tressis, and I'm Keith McCullough. You know where to find me.